Hello and welcome to our April 2026 Outlook and Positioning video. I'm Derek Varner, going to give you an update today on what's been happening in the market and the economy. I'm joined by my friend and colleague, Mike Allison. Good afternoon, Mike. How are you?
Great, Derek. How are you?
Good. We've got a lot to talk about. A lot has transpired in the month of March, and so we want to give an update to our clients and our faithful viewers. So without further ado, let's launch right into performance. So far this year, despite all the headlines and consternation in the market, through the end of March, the S&P 500, or the 500 largest companies in the United States, weighted by market cap, is down about 4%. So we've had somewhat of a pullback. I think at its worst, that was around down 7, 8%.
Um,
And then we had a little bit of a recovery in the end during the end of March. But when you look across other asset classes, things like more value oriented, a more value oriented version of the S&P, flat. Dividend stocks actually up mid-single digits as a basket this year, and then foreign stocks about flat as well. Things like commodities, oil, gas, precious metals, industrial metals, et cetera, doing very well this year because of the uncertainty and because of higher energy prices and other higher input prices. So far, we things, while volatile and obviously very concerning for a variety of reasons, which we'll talk about in the video today, so far portfolios and asset classes are holding up reasonably well. But Mike, what are your observations on the first quarter of the year so far?
yeah, I think it's a reminder that things can be going along reasonably well, and then all of a sudden some externality comes along that the market had not anticipated, and or many of us had not anticipated, and then now the market has to go through a process of pricing in that uncertainty, and given the nature of it and uh, the crosswinds, on any given day there's you know announcements or actions or what have you that can sway the market both directions. So that's why it just feels very choppy and directional. It's because the market's trying to find its feet in terms of how do we discount what the longer term impact of this is, not next week or next month, but next year and then beyond.
Yeah, that's exactly right. And we've been in that same process as investment professionals and stewards of our clients' capital, really trying to understand what do these events, what does the conflict in Iran really mean in terms of its impact on the market and the economy. So some of the key changes that we've made over the last 1 to 2 months have really been acknowledging that this event, whether it's shorter lived, if we're in, I think, around week 4 now, or if it becomes a much longer engagement or conflict in the Middle East, we think it'll have a renewed impact on inflation in a negative way, or prices will continue to rise.
We, just like the market and investors in general, are trying to assess the longer term impacts of the conflict in Iran. Higher oil prices in the near term is an obvious one, but there's a number of other non-obvious ones that could have a longer term impact. Tankers not being able to flow through the Strait of Hormuz. 20% of the world's oil goes through there, but a significant amount of other um, commodities that are important to the global economy. Fertilizer. Here, fertilizer is having a difficult time getting out of the strait and getting out to farmers who are needing to plant their crops. It's a really bad time of year, so we fear higher food prices, which is going to reignite inflation in a different and perhaps longer lasting way. Helium, which is another one. A significant amount of helium goes to the Strait of Hormuz, and that's very important for semiconductor production, for example. So we think the obvious near-term impact on oil that could resolve reasonably soon if the conflict comes to a close. But the thing we're really wanting to focus on is what are the longer-term knock-on effects that aren't so obvious.
Well said. And we've one of the ways we've tried to relay that to clients and how it impacts our calculus with respect to constructing portfolios is the acknowledgement that this may be a renewed bout with higher inflation in the areas that Mike described, whether it be energy inputs or agricultural inputs. So we've moved our inflation dial to negative, and slightly below neutral. We've also moved households to negative and the overall economy dial to slightly negative, as an acknowledgement that households have been fairly, on average, the average household has been fairly stretched and having trouble keeping up with higher costs for the last few years, really since the pandemic. And then this may be a new bout with higher costs and inflation that could be the straw that broke the camel's back with respect to households. So we have gotten a little bit more concerned about the economy, primarily because of inflation. So that's one of the reasons why we hold a balanced portfolio, and it's why we own things like commodities and many client portfolios that can benefit from an inflationary environment.
I would add to that, when we say a renewed bout of inflation, what we're not saying is the 9% inflation that we saw coming out of the pandemic. We're really focused on, we could see a inflation that's remains above the Fed's target, for example, and which would maybe prevent them from lowering short-term interest rates. So the market has to figure out that part as well. So we're not forecasting a return to the 1970s, for example. We certainly hope not, but we do think that we could sort of have higher for longer inflation and kind of truncate the progress that had been made over the last couple of years.
So that's some of the things that are concerning out there. Some of the positive things that we're noticing are that AI it continues to get better, and we're seeing higher and higher adoption amongst companies. So if you have watched these videos, you'll know that we're big believers in the long term. When I say long term, I'm talking about years and even decades of AI being a potential big productivity driver in the United States and globally. One of the things that's interesting is we've seen a significant amount of new business formation in the United States as well. So after the pandemic, this really moved higher. And then in the kind of post AI world, we're seeing business formation tick higher as well, which is an interesting thing. We'll have to watch and see what that really means for the economy. But I think it implies that there's a lot of enthusiasm out there, and folks are comfortable taking a step and trying to be entrepreneurs, which is, I think, always a positive thing.
Yeah, there's a lot of headlines that you hear all about AI going to take all of our jobs and all that sort of stuff, and fears of that side of the equation. But this is a really, I think, interesting graph, because it shows reinvigoration of business formation, because AI helps lower the cost or barrier to entry, for example, for people starting their own businesses. I think we're going to see more and more of that, particularly with young people who are coming into an economy that is changing. And say the recent college grad who's having a hard time getting a job because the structure of the employment backdrop is changing. Well, that person's going to be very AI averse, or very AI versed, and really see what they can do to get something started on their own, or with some colleagues and that sort of thing. So we're encouraged by the long-term promise of this, and not so focused on the negative headlines about job loss due to AI.
Another positive element of the last few weeks is that stocks have gotten cheaper. So this is the S&P 500 over time. So again, the 500 largest U.S. companies, and valuations had moved to a point where, just through early this year or early in February, were looking extended to us, at least for that asset class. Now, as clients know, we invest across a lot of different asset types, but the S&P 500 being one of the ones that gets the most attention in the media, kind of the bellwether. So we do track this individually, and you'll see valuations have come back down to a more kind of reasonable range, or within a range of normalcy. But all the while, and in part is what Mike's describing with respect to AI. I think there's a lot of enthusiasm about companies continuing to earn higher and higher amounts each year, and then in the future earning higher and higher amounts each year, largely driven, in our opinion, by number one, economic growth, but really AI and innovation and productivity gains. So this is one reason we're optimistic in the long run. And we have not seen a significant decline in earnings expectations despite the conflict in Iran. So we're going to go through earnings season here in a few weeks, and we'll start in a week or two in kind of early mid-April, and we'll see what companies are saying about their future forecasts. We'll see what they're saying about uncertainty with respect to the conflict in Iran and energy costs. But today, markets are anticipating higher earnings in the future, and that tends to drive stock prices. What are your thoughts, Mike?
Yeah, exactly that. I mean, earnings drive market returns, and earnings are a function of the companies we invest in. And it's important to not think about the stock market. It's not important not to think about numbers on a screen, but these are actual businesses that we invest client capital in. And to the extent that they continue to show strong earnings and continue to create the expectation of continued earnings growth, then that's going to drive markets higher. And so over the long run, we're continue to be constructive. And this is a great chart that Derek shows here. Go ahead, Derek.
Yeah, well, I think it's helpful. This is something we try to share with clients as often as we can, but in particular during periods of not only market turmoil, but also periods of market enthusiasm. It's good to remind folks to have a balanced portfolio, an all-weather portfolio that can ride out the market ups and downs. But at the end of the day, we experience events that are significant at the time and do feel very significant and concerning at the time. But if you have a long enough investment horizon and the economy continues to grow and we continue to see innovation and new inventions, then in the rear view mirror, these things tend to look like speed bumps toward achieving one's long-term investment success and investing goals. So we think that this current season will be another one of those events where we look back on it and it was very concerning at the time for a lot of good reasons, but it may have presented a buying opportunity, particularly in the long run. What are your thoughts, Mike, as we close out this month's video?
Yeah, I think the headlines related to the conflict in Iran are difficult to deal with on an emotional level, but I think that optimism always wins in the long run, and I think that the chart on the screen here shows that. And sometimes you have to ride out the storm, but stay the course, and that's how you build wealth over a long period of time.
Optimism always wins. I love that. Let's close with that. So thank you everybody for watching this month's video. We look forward to speaking with you about your portfolio, and happy to do it anytime. Please reach out. We'll get something on the schedule. But in the meantime, thank you for your trust in our management of your wealth, and have a wonderful spring season. Thank you, Mike.
Thanks, Derek. Great to see you. Thanks, everyone.